Brent crude settled above $100 a barrel, but energy stocks did not carry the same conviction into the close. That tension is the useful part of Thursday's session. The oil shock was real. The broad tape reacted. The S&P 500 fell, volatility rose, and the usual inflation and shipping questions came straight back into the portfolio conversation. Yet XLE and Occidental Petroleum opened higher and then surrendered most of those opening gaps before the bell. My read is that the market priced immediate supply risk faster than it priced durable producer earnings. The oil move was real, while transmission into producer equities remained incomplete. And this matters because a headline can be directionally right while the obvious stock trade still disappoints. I want to separate the event from the equity response, show where that response faded, and map the levels that would turn a weak confirmation into either a broader energy move or an outright rejection. According to the Associated Press, attacks hit 2 Saudi oil tankers in the Red Sea. That put another shipping route at risk alongside the Strait of Hormuz and pushed the supply risk premium higher. AP reported that Brent settled at $100.69 per barrel, up 7%, after trading as high as $102. The mechanism is straightforward. When a tanker route looks less reliable, traders have to price the possibility of slower flows, higher insurance, longer voyages, or some combination of them. None of that proves physical barrels have disappeared. It does raise the cost of uncertainty around getting those barrels to buyers. The next question is whether that premium spreads into the assets that should benefit from more expensive crude. On Thursday, that link was much weaker than the oil headline. Start with the broad close. The S&P 500 finished at 7,408.30, down 1.21% from the prior close at 7,498.96. The session low was 7,376. That bar confirms general risk appetite weakened during the oil shock. Buyers repaired part of the intraday damage, but the index still closed below the prior close and remained near the lower part of Thursday's range. The downside level is 7,376. A later close below that low would extend the broad risk move. The recovery level is 7,498.96, the prior close. A close back above it would repair the part of the sell-off visible on this chart. I am not treating the index decline as an oil-only verdict. Earnings reactions in large technology companies also weighed on the tape. The S&P chart simply establishes that risk appetite weakened. At the same time, the oil premium rose. Buy supplied the independent confirmation. It closed at 18.69. Up 12.32% from 16.64 after reaching 20.31 intraday. The close matters because it held a meaningful portion of the volatility bid. This was not a scary headline against flat implied volatility. Broad equities fell while implied volatility rose, a coherent risk-off pair. 20.31 is the stress level on the capture chart. A later close above it would show that traders are carrying more protection than they did at Thursday's bell. 16.64 is the lower reference. A close back below that prior level would remove the volatility confirmation from the story. Together, the S&P and VIX charts say the session contained real broad risk. They do not explain why producer equities failed to keep their opening gains. For that, the energy charts matter more. XLE is the cleanest chart in the package. It came into Thursday from $59.20. It opened at $60.24.4, reached $60.37.68, and closed at $59.38. The arithmetic is the point. The opening gap was $1.04.4 above the prior close. By the bell, only 18 cents of that gap remained. XLE still finished positive, but most of the opening response was gone. That is weak confirmation beside a 7% Brent settlement move. If the supply risk premium were flowing cleanly into the producer basket, I would expect the sector to hold more of the opening bid. Thursday did not deliver that shape. The range now gives us a decision map. $59.20 is the prior close floor. $60.37.68 is the session high. A close above the high would show the sector accepting a higher range. A close below the floor would turn a weak positive response into outright equity rejection. Until either level breaks, XLE is evidence of incomplete transmission. Occidental Petroleum repeated the same pattern at the single name level. OXY came in from $57.50. It opened at $58.64, reached $58.99, traded down to $57.50, and closed at $57.60. The stock opened $1.14 above its prior close. It finished only 10 cents above that reference. Most of the opening gap disappeared before the close. The capture levels are $57.50 on the downside and $58.99 on the upside. A close above the high would show buyers accepting Thursday's higher prices. A close below the prior close floor would show that the opening oil bid failed to establish support. The same weak confirmation pattern appeared at both the sector and single name levels. The sector basket and a producer with direct crude exposure both finished green, but neither chart carried the oil headline through the full cash session. Why can crude rise sharply while producer equities barely hold a gain? The crude contract price is the barrel. A producer stock price is much more than the barrel. Production volumes, hedges, transport access, royalties, operating costs, balance sheet risk, capital spending, and the duration of the commodity move all sit inside the equity price. An abrupt shipping threat can lift crude immediately because the contract is the fastest place to express supply risk. Equity buyers have to decide whether that premium lasts long enough and reaches realized company prices cleanly enough to change future cash flows. They also have to price the broader damage from expensive energy. Higher fuel costs can pressure consumers and businesses, lift inflation concerns, and keep interest rate risk alive. Thursday's close does not reveal which of those concerns dominated. It reveals the result. The oil benchmark carried a large event premium, broad risk weakened, and producer equities did not retain most of their opening gaps. That is why I will not turn a geopolitical headline into a simple buy the producer's conclusion. The event belongs to the news source. The response belongs to the charts. Right now, those evidence sets point in the same direction for oil risk, but in different directions for producer conviction. Who got paid and who got hurt? Oil exposure held before the event benefited from the higher settlement. Broad equity holders absorbed a weaker index close, while holders of volatility protection saw VIX finish higher. Producer equity holders got a mixed result. XLE and Occidental closed slightly positive. So the session was not an outright loss from the prior close. But anyone who chased the opening gaps held a very different position by the bell. The sector and the stock both finished close to where they started the day before. Fuel-intensive businesses face the opposite mechanism. Higher crude can raise operating costs faster than those companies can raise prices. That link remains qualitative here. The portfolio lesson is narrow. Commodity exposure, producer equities, and fuel consumers are different instruments with different transmission speeds. Thursday rewarded anyone who kept those distinctions clear. The headline was about oil. The divergence was about what the equity market refused to capitalize. The opening bars show how quickly the obvious energy trade was attempted. The closes show how much of it survived. XLE opened more than $1 above its prior close and finished 18 cents above it. OXY opened $1.14 above its prior close and finished 10 cents above it. In both cases, buyers paid up at the open and then lost control of most of that premium. I do not read that as proof the geopolitical risk will fade. Price cannot verify diplomacy, shipping access, or physical supply. I read it as evidence that producer equities had not followed the oil move by the close. That distinction prevents hindsight. The oil premium was already visible in the settlement. The equity charts then tested whether the premium deserved a durable earnings multiple. Thursday's answer was incomplete. The next session does not need another dramatic headline to clarify the trade. It needs a close outside the captured XLE and OXY ranges. Acceptance above the highs would broaden the move. Loss of the prior close floors would show the equity market pricing more risk than reward for producers. My base case is continued incomplete transmission. XLE remains between $59.20 and $60.37.68. OXY remains between $57.50 and $58.99. That keeps the oil event large while the producer response stays trapped inside Thursday's range. The broadening case needs both producer charts to clear their highs. XLE closes above $60.37.68 and OXY closes above $58.99. That pair would show the sector and the single name accepting the higher range together. The unwind case needs both prior close floors to fail. XLE closes below $59.20 and OXY closes below $57.50. That would invalidate the idea that Thursday's reconfirmation was merely a pause. The broad risk overlay sits beside those branches. S&P weakness below 7,376 with VIX above 20.31 would keep pressure on equities even if crude remains expensive. An S&P recovery above 7,498.96 with VIX below 16.64 would remove that broad confirmation. Every branch requires a close. None is a forecast. I am watching whether the Red Sea shipping threat persists. Another credible report of an attack, a route restriction, or a material insurance response would keep the event channel active. Documented de-escalation would reduce it. Headlines alone do not settle the equity question. The closes still have to confirm. On XLE, watch $59.20 below and $60.37.68 above. On OXY, watch $57.50 below and $58.99 above. For broad risk, the S&P level is 7,376. The VIX level is 20.31. Paired S&P break lower and VIX close higher will show the risk-off move expanding. Failure to produce that pair would keep the producer divergence at the center of the analysis. XLE is the deciding chart. A close beyond its captured range tells us whether producer equities are beginning to confirm the oil move. Brent closed above $100, and the obvious producer trade still stalled. The S&P 500 fell, VIX rose. XLE opened more than $1 above its prior close and finished 18 cents above it. OXY opened $1.14 above its prior close and finished 10 cents above it. That is a real divergence, not a reason to dismiss the oil event. The benchmark price shipping risk immediately. Producer equities asked for more proof that the premium would last. Watch the XLE high at $60.37.68 and the prior close floor at $59.20. Those levels decide whether the producer basket accepts a higher range or turns weak confirmation into rejection. Subscribe for Friday's post-close map. This is market news and education, not financial advice.